Hello, hello, hello. We are live. We are live. We are live. Come on in. Come on in today. We are going to talk about real estate, obviously, especially if you follow me. Um, we are going to talk about how you are buying real estate wrong. If you are buying real estate right now, you're probably buying it wrong. Why do I say that? Just want to come on in, and let me go back first. If you are in this live stream, you probably are either a broker, a real estate agent, a wholesaler, or an active investor, or someone who is looking to be in either one of those spaces. Because I speak a lot about who is actually selling real estate, whether you are, again, a broker, a real estate agent, or who is a wholesaler or someone that is selling their own properties. And just for my Instagram live, I'm going to be looking at you guys, but I am actually also recording a YouTube video. So you're going to see me look at another camera often. All right. So if you are in one of those sectors and you are often selling real estate, you probably will find a lot of benefit of coming to my channel. But for this one, it's for everyone because my goal is to help real estate agents learn the investor buyer better, whether it be a rehabber, a flipper, or a builder or developer, so that you can get that information and you can gain that knowledge so you'll know how to serve them best. All right. So if you are buying real estate right now, you're probably buying it wrong. Why? Because right now, everyone knows what type of market we're in. We're in a market where, although it is a buyer's market, it still is not. I say that because interest rates are high. Right now, if you have a over 700 credit score, you probably get an interest rate of about 6.9. And that's right now, that's on the lower end. If you have anything lower than that, you're probably going to get an interest rates in the nines, maybe even in the tens. If you are trying to, especially if you're trying to buy a real estate investment property. Now, there's a lot of different ways that you can structure these type of loan products, especially if you're going to a private money lender. But I'm not going to get into private money lending right now. I want to just specifically speak on if you're buying rental property and you're relying on some type of financing institution to supplement anything that you don't have that's part of the down payment. So if you're buying it wrong, if you're only looking to work with traditional lenders, because one, there's a lot of regulations already when you're buying property. So you need to be able, especially for all my brokers, real estate agents, and my wholesalers, you need to understand that the typical buyer that you have right now, especially if they're an investor, they're not going to be able to get the free money or the good money like they had just 18 months ago, okay? Because they don't have interest rates of 1%, 2%. We're talking 6%, 6.9, 7%, 8%, and that's with decent credit scores. And then they have a lot of other stipulations around it, such as 15% down payment on the loan, right? And then you can only have so much contribution, and they have to buy within a certain value range. So when we're talking about all these things, we start looking at how much money will it actually, how well is my money working for me? And when you break down and you do like an estimated cost statement and you run the numbers, you realize that as an investment property, it doesn't work well because we're already at I used to say we're at the top of our rental rates, but it seems like they keep going up even a little bit more. But for the most part, we're getting at the peak of our rental rates as well. So when we look at what we can actually acquire the property for, right? How much money is it going to take? Meaning PITI, our payment, interest, taxes, and insurance. After all of that is deducted, what I have to pay out and what I can bring in for this property, does it make sense for me? And so I say you're probably buying it wrong if you are going to a traditional lender. If you are going and trying to access, and and especially if you're a real estate agent or if you're a broker, if you're advising or giving getting preferred lenders list out to your investor clients that only have traditional lenders on it, you're teaching your other investors to buy it wrong as well. It's very tough. And I say this speaking on experience. I actually have a deal right now where I've been trying to get the investor over. He's still new. Been trying to get him over to a private money lender. That the interest rates are higher, but it still made sense for the deal. But it was such a tough deal because the traditional lender that he really wanted to go with, that he had a relationship with, it was just so much red tape over because it was an investment property. So let's get into it. I want to talk about creative financing. All right. So creative financing is something that all realtors, brokers, wholesalers, and even you as the investor, you should learn what it is and how you want to start structuring your deals, especially in this type of market when there's high interest rates and the cash is so expensive right now. Okay. So I'm going to go over a couple of terms, and get your pens and notepads out, especially if you're on your lunch break. I did this because lunch break, let's take a time and let's learn some stuff, right? So what you want to do is first you want to write down what creative financing is. Creative financing, whenever you hear about seller financing, owner financing, subject to existing mortgage, and assumable financing, those are all creative ways to do deals, right? And those are just a few, but those are the ones I'm going to be talking about today. All right, so let's jump into it. Subject to, let's talk about creative finance, okay? Seller finance first. So seller finance, the definition of that, and this is my own Kelly definition. The definition of a creative finance is when you work out financing that is subject to the seller's terms, right? So you and seller agree upon the terms. The seller owns the property. You two agree upon the terms, which means what are terms? So the terms are, what will be my payments, right? How long will I pay you those payments? And at what interest do you require on that money in order for me to borrow that money over time? Is there going to be a balloon payment? Meaning, is there going to be a set amount of time where even though it is amortized, meaning like if it's over 30 years, 15 years, 10 years, that's amortized over a certain period of time, are you going to require me to pay back the full loan balance in a set amount of time prematurely, right? Or early, right? So that means that's what the balloon payment means. So your balloon payment means that if you say you owe me $400 each month at 6% interest, right? And it's going to be amortized over 30 years. So my payments it's going to be amortized what it would look like if I paid you the entire 30 years. However, I want my money in 3 to 5 years, or you have a set time. I want my money back in 5 years. So that means that although it is scheduled payment for an entire 30 years, you're required to pay that loan in full by 5 years, right? You just don't have the payments, just don't look like that in 5 years. Okay. I hope that makes sense. So those are what terms are. So there's a lot of different ways to structure terms when you're doing seller financing. The beauty of seller financing is there are no banks required. There is no, if the seller does require it, there's usually not a lot of credit score is usually not an issue because sometimes they may require a credit score or credit report to pull your credit report. Sometimes they may not. It just may require you to come to the table with a certain amount of money. They're not going to be looking into your DTI. They're not going to be looking into how the money was sourced. So they don't care if you had funds that were gifted to you. They don't care if you had got the down payment from a loan or off a credit card. They don't care. They don't care how long it's been in your bank account. As long as you show up when you told them to, when you guys agreed on it, and you said that you're going to give them this amount of down payment to do a seller finance option, which is over a certain amount of time, they don't care, right? So you lift all of your underwriting. There's just an agreement between two people. And so how does brokers, sellers, wholesalers cultivate or help facilitate this type of transaction is first, you want to talk to the seller and educate them on this. of saying, hey, it is a market where if you're looking to sell and you're okay with still holding on to some real estate, but you don't actually have to manage the real estate, right? You don't have to be a landlord. You don't have to act in that capacity, but you do receive dividends each month. You can look at it like that on real estate that's backed by real estate. Would you be open to talking about terms? So when we talk about terms, you want to talk about, as a seller, what would be the least amount of money you would take right now up front if I can pay you the rest over time. That's like my number one statement that I say to all of my sellers that I talk to, that I'm looking to do some creative financing with when their asking price doesn't make sense for the market that we're in, right? And that happens a lot. To my Instagram people, that happens a lot. When you're talking to some sellers, they're still asking for this price when the market shows that we're at that price. Okay, we're not there, right? We're not there yet, but how can I get to this price, but I do it over time versus doing it faster? That's all what creative finance and what a seller financing option is. Means that the seller still holds the note. Your buyer actually has the deed transferred over to them, and they have the same thing as a mortgagee would have. They have basically you put out an IOU or a promissory note that says that in the event that if this buyer stops performing on this note, I get to take the property back from them. All right, so let's just go back over what seller financing is. So seller financing is the owner themselves owns the property. They're willing to take some of the money, which they're asking price to sell their property. They're willing to take some of that money now and the rest over time in payments based on whatever terms you have on paper, right? So when you're looking at it in that respect, then you can get a lot of houses sold if you have a lot of sellers that are willing to do this. Now, there's going to be the regular Joe Smo seller is not going to be on board for this, right? A seller that needs to hurry up and relocate, a seller that needs to, that is okay with, basically getting top dollar for their house. They'll rather keep their house on the market for a certain amount of time before the house sells. When this strategy works the most, it's people that are already been investing in real estate and they have a portfolio that they're looking to liquidate. Or when you are speaking with a seller that is in distressed, right? They are looking to just get out. They are not looking at how much money they can make. They're trying to figure out how much money they can stop the bleed from, because they're paying taxes or paying repairs on the property or doing or HOA fees and other fees. They're trying to stop the bleed versus them coming back. They're thinking about how much of a return that they're making. Okay, so that is seller financing. Seller financing is what you actually set up terms for financing with the actual owner or seller of the property, and you agree on those terms over time. This also can be referred to as owner financing as well. So seller financing, I don't use seller and owner interchangeably. Sometimes I try to stop myself when I do, because the seller of the property may not be the current owner of the property. And if you're wholesaling, you know exactly what I mean, meaning that you can have a contract out on a property and have equitable interest on a property, but you may not own the property yet. But you have the right to sell the property as you're working to close on the property. Owner means you actually have title. You actually have title, you have deed on the property. So you actually own the property. So it's very common. I try not to use owner and seller interchangeably, because there is absolutely a difference in the two. All right, so that is seller financing. So the other thing I also want to talk about when we're talking about seller financing or owner financing is that, like when we just said, credit is usually not an issue. How you source the funding is usually not an issue. The only issue, well, I wouldn't say issue, but the only thing that's not as easy is finding these type of sellers. So you want to make sure that if you're a realtor or you're a broker, that you link up with some companies like wholesaling companies or investment companies that specialize in finding these type of sellers. Because What that means is they spend a lot of money in marketing to do outreach for these type of sellers. They have call centers. They're doing cold text messaging, cold talk calls. They're investing in Google ads and running Facebook ads and TikTok ads and whatever marketing they need in order to get these type of sellers where they can structure these type of deals. Why does this help you as a broker, seller, or wholesaler if you're linked with those companies? Because usually they already have a marketplace available for you or inventory that is off market available for you, that if you have a buyer that is looking to get into something like this, where you know their credit is not right yet, but they have the cash and they can make the payments, and you know they can make on-time payments every time, you want to link up with those type of companies to provide your buyers with more options than just the MLS, right? Because the MLS is usually going to be require either cash or conventional funding. The creative finance is not set up in that way. It's set up for what they call retail buyers. So if you are an agent and you have been experiencing a drop off in your buyers because you can't get them qualified for loans, then you want to start exploring these kind of companies that specialize in doing owner financing with sellers, because then you open up your inventory, you open up the possibilities of getting more deals done. And yes, you get paid in that, because part of that down payment will go towards commissions and other payouts for that. That's partially what the down payment is for. So you don't have to think about, oh, well, how will I get paid? Well, you get paid in that down payment, right? When the buyer sends that money over, that's how the deal is done. And so the seller just uses the down payment, partial pieces of that down payment, to pay back commissions and wholesale fees. I hope that makes sense. I'm not answering questions just yet, so just remember, but I am going to answer questions at the end. All right, so that's seller finance or owner finance, however you want to word it, based on who you're talking to and how you reach out to those people. Now, if you are someone that's looking to get more sellers, or you know sellers that have mentioned, like, I might be open to, renting out. Let's just say a seller, if you're a realtor, a broker, or you're a wholesaler, and when you ask them, what would you do if you could not sell your house today? And they say to you, well, I would probably just rent it out. Well, then you say, well, if you will rent it out, you don't need all the money right now. Would you be willing to, if I could bring you a buyer that can pay you money, some of your money now and the rest over time, would you consider selling the property on owner finance or seller financing terms? And if they say yes, then now you can put a deal together, right? So now you can bring your buyers over that have the credit that needs to be repaired, but however, they also have the cash, right? They also have the cash. You can bring that seller and that buyer together, and now you have a deal, okay? And just think about how many times you can do that. I mean, right now in this market, I'm pretty sure there are a lot of sellers and a lot of buyers that just need to be linked up together, that are willing to, do some creative financing. Everything will be legal. Everything will still go through. So let's just talk about that, right? Let's talk about, we put a deal together. We have an agreement, right, between seller and buyer. We have a meeting of the minds. What next, right? So what next, what happens is you still go through your closing attorney. You still want to run title. Still want to do a title search, because you don't want your buyer, even though that they have a problem getting conventional or traditional financing, you still don't want to put them in a situation where they are taking over a property that has a lot of liens, tax liens, mechanical liens, whatever kind of liens on it, or it's in an open dispute with in a probate. So you still want to do your title search. You want to still put it open escrow on it. You still want to have the earnest money deposit down on it, right? And so you just have this different type of contracts. Now, your typical contracts that you use at your brokerage, or your typical contract that you use is for a cash sale, will not work in this situation, right? Why? Because there's a lot of other clauses that need to be understood. There are clauses that understand of how we're financing the deal, and what payments and what the terms are. All of that needs to be in writing. So your typical contract won't work. For me, I have several contracts. I have contracts for all the different type of financing that I'm going to do, whether it's cash, whether it's conventional, whether it's creative. I have different contracts because one contract doesn't fit all, right? So I have contracts in place. And when you send that contract over to the attorney's office, and pro tip is, if you use an attorney's often always, right? If you use attorney's office often, you want to tell them what you're going to start doing, and then you just actually just pay for their service to write up a contract for you, so that you know, and you can also tell your seller and your buyers, this has been drafted, this has been created by an actual real estate attorney, okay, so that they have peace of mind, right? So you send those contracts over, and then you and then once you have those contracts over, you open up escrow. Only thing will happen then, because you don't have to worry about, now a buyer can order their own appraisal if they want to. You know, I would say in my contract that it wasn't contingent on appraisals, just simply because it is a creative finance deal. Most of my finance deals are not contingent on appraisals. Let me repeat that. Most of my finance deals are not contingent on appraisals, because if we're going out and we're making a lot of concessions so that you can just get in the house, we're not gonna get. Now it's gonna be market value, right? You can do some comps on it. You're gonna make sure it's market value. You don't want your seller paying $300,000 for $100,000 house. Like, we're not gonna do that. But you want to make sure that it's market price, right? But it's not going to be contingent on appraisals typically, unless for some reason, you know, your buyer is a more savvy buyer, and they require it for some reason, right? So, but my point to this is, usually a closing can be within 10 to 15 days or less, maybe even 7 days, especially if the buyer already has the funds in their bank account. Because once you run title usually takes about 3 to 5 business days, depending on the type of search it is, but typically about 3 to 5 business days for title to come back on a property. Once the title is back, then you can close, because it's just simply, the terms are already there. There's no underwriting process. There's no appraisals. It's just the cash that needs to be exchanged, and then they draft up the deed and they record the deed. So the process is a lot simpler when you are dealing with a creative finance deal as well, because you don't have to go through underwriting and appraisals and all of that great stuff, and sourcing of the money. You don't have to go through all that entire process. So it makes it a lot easier for people to actually close deals quicker. Now, the thing about seller finance, owner finance, is usually interest rates are a little bit higher, because again, the owner is holding the note. So basically what happens, and also another great talk track, if you are a broker, realtor, or a wholesaler that is educating a seller on what seller financing and owner financing is, they become the bank, right? Because you take the bank out of it, they become the bank. They hold the note. They don't own the property anymore. The property transfers over to the buyer, but they hold the note, and they can, and their note, their investment is backed by a piece of real estate that they're the most familiar on, right? So that's a beauty. That's the beauty of it. If you are talking with a seller or owner that has some background in investing or understands investments, right? That's a beautiful thing. So you'll want to educate them on that piece, right? Now, interest rates, that is the biggest things. Right now, like I said earlier in this video, is that interest rates right now for about a 710, 720 credit score, are about 6.99%, right? High. So usually seller financing is about the same or more, but more usually. Usually about private money lenders usually are about 1.25% more, and usually sellers are about that much more. Another way with how you can determine what you want your interest rate, you can reverse it. I always tell people, when you don't know the answer starting out, you always just want to reverse it, right? So when you reverse it, you get your answer. So take, for instance, if you have a buyer that already is able to pay market rental rates in that area, let's just say market rental rates in that area is $1,700, then you make your payments on the house $1,700 or $1,750, right? And then you're just backing in what that interest rate is, or what the principal payment would be. But you just make your payments the same as the market rent. The only thing is now they actually own a piece of property versus renting a piece of property. That's a gem if you guys didn't know, like how we structure deals. Like I structure a lot of creative finance deals. I usually do it like on pieces of land or commercials, but or development stuff. But this is definitely can happen on houses, right? So that's the best way that I would say is to, if you can't figure out what your term should be, back end it, whatever the market rent is, that would be your the payment that the buyer will have, right? So all right, so I feel like, okay, I've been going about 20 minutes on the seller financing, owner financing structure. So I feel like we've got that covered. You know the basics of it. Rewatch this video because I will save it. Rewatch it. It'll be up on my YouTube channel. If you want to rehear some stuff, go ahead and do that. All right. So next is subject to financing, which is my favorite. My favorite is because I stumbled into subject to financing when I was wholesaling a property that I didn't want to get rid of because it was just such an awesome, and I wanted to help the sellers because they were in a really distressed situation. And I know that if I didn't help them, I knew that they were going to go into foreclosure. And I wanted to do everything I could to stop foreclosure. So when I hear people talking about foreclosure, just know that if you don't have the heart to work through those type of deals and you don't care about the people on the other end, like you probably won't be great at it, because you have to really want to help people, because foreclosure, going through that process is very draining. And you'll notice that the more people that go through foreclosures that you help, they had disconnected themselves and withdrawn themselves from the situation because they didn't have any more answers or solutions for the problem. So they just wanted to disconnect and just say the banks can have it. But when you come in and you have all the answers, then they start to get really hopeful again. And so that's my tidbit on if you're ever helping like sellers go through a foreclosure and try to stop their foreclosure for them. All right, so let's talk about subject to financing. So I bring that up because a lot of your deals will be had through foreclosures. Foreclosures are up. They're mainly up because a lot of foreclosures were postponed over the COVID pandemic. So now that banks are catching up and values are up, banks are trying to foreclose on everything because their values are up. That's the difference from where it was in 2009 versus now. Is values were down. Banks were trying to figure out short sales and figure out ways to keep people in their home and have them pay just a little bit, or at least take as much as they can on the property. But now values are up, interest rates are up, but values are up, and so there's an opportunity for banks to make all their money back on the properties, especially if they just sell at like 20% discount, right? So that's why you see a lot of foreclosures that are happening really fast. All right. So subject to financing. Subject to means subject to the existing financing. That means that someone already has, the owner has a note on the property. And I shall add that when I was talking about owner finance, seller financing, typically that's when the property is owned free and clear. Okay, I should have made that very that when I was talking about it. So when we are talking about subject to financing, subject to the existing mortgage, right? That means that an owner has their name on a loan, but they are ready to sell. And for some reason or another, they can't get their asking price for the property. They're in some type of distress and they're ready to move on. So whether it's a foreclosure, right, and they're behind on payments, then they still have a loan attached to the property for that particular and for that sale, right? But maybe it needs repairs. Let me just use my example. So when I purchased my very first subject to, like I said, I was thrown into it. I didn't know anything about it. It was in 2016, 2017. And the property needed a lot of repairs. Like everything needed to be done, right? But then they still owed on the property, and the repairs on the property, when you add up how much they owed plus the repairs that was needed, it didn't make sense as an investment. You're just too much money into it already because what the market value at the time was. It just didn't make sense. And so the only other options were to do subject to the existing financing, meaning I will take over your payments for you on your behalf if you transfer the deed over to me. Because let me go back also, and for people that don't understand that concept, is your lien, your mortgage on your property, the bank doesn't own your property. That's why you pay taxes on it. You pay taxes on your property that you own, but they are financing. They take a lien out on the property. That's why it's a promissory note that's added in your documents when you do it, because they want you to promise that you'll pay back this loan on this asset. And if you don't do it, we'll take it from you. That's what a foreclosure is. That's why they have to foreclose you. That's why it's not an eviction, right? Some people don't understand that. Like, it's not an eviction, it's a foreclosure, meaning they'll take the property back from you because you foreclosed on your because you did not keep your promise to them that you were going to pay them back this amount of money over time until it's paid off for this particular property. So that's what is subject to the existing financing, and that's how your mortgage and your deed works. So what happens in this situation is you just give you the basic, and the subject to the existing the mortgage agreement is the buyer will come in and take over the payments that you already have in place with the mortgager. And in return for this, the seller would transfer the deed over into the buyer's name. So now that they have rights to this property, right? And they also have a responsibility to pay back the mortgager that has a lien against that property. So that means that when this property transfers over to them, they are taking in all the liens, all the responsibilities, all the assets that it comes with, all the liabilities it comes with. And one of those liabilities is the mortgage, right? So that's subject to the existing financing. There's a lot of questions that happen with that. And it honestly, subject to financing is an entire course. Like Pace Morby is one of the greatest ones. I know that I'm in his mastermind. Like he does a really great job at breaking it all down. 20 minutes that I'm giving you is just a high level so that you know that it's there so you can seek more information. All right. So when you do the subject to the existing financing, right, and you have on paper that you're going to take over the liens and the seller is going to transfer you the deed. Now, typically a seller is going to transfer you to deed. Sometimes they're going to want cash to transfer the deed over. And it really depends case by case. If the property is just really trash and you're really doing them a big favor, then sometimes it may be nothing. But if they need money to move and they need, some type of, and the property does have a little bit of equity in it, then you can figure out some type of fee to get that deed over to you, and you also take over the responsibilities of the actual mortgage. So that is an amazing way how I was able to get into my first deal, because that's what I did. What I did is the property was completely, it was not in great condition. The mortgage they owed, they still owed too much for me to buy the property outright, because they would have to pay off the mortgage, and it just didn't make sense because of all the repairs that need to be done. So I told them, listen, this is what I can do. This is after having them under contract for like 3 months, because I was really trying to help them out, and I had started paying their mortgage for them. Because I knew that I could figure it out. I just needed the right investor. But it just took me longer than I expected. But I started paying the mortgage for them. I got all that money back, obviously, but I started paying the mortgage for them until I could figure out what I was gonna do with this property. And so when I came across subject to financing, I came across it from another guy, actually, not the Pace Morbid, but from another guy, that was teaching it. I was like, aha, there it is. So what we did is we created an agreement that said that I would take over the payments, and they gave me all of their statements. I knew who the lender was. I had power of attorney over that particular property. Just for that particular property. It's called limited power of attorney. I got power of attorney for that property. So now I can talk to their bank that had the loan, the mortgage against that property. I can talk to that bank without them. So now that I had that all notarized and everything. So now they know now that keep with the payments, keep with the same interest rate, same terms. I'm going to take over these payments. I'm not going to assume the mortgage, but I'm going to take over these payments, and you can send the bill in their name to this address now. And so that's what happened. So I started doing that. We closed on the property. The deed was transferred over into my name, and then I took in a lease. I got someone to lease the property out, and their part of the agreement for keeping like the rents really low and everything was that they would fix up the property because their rents were like way below market value. So that's what we done on that property. And so that's what you can do on these particular situations, because there are going to be some people that have not decided that they weren't going to pay their mortgage during the pandemic, and it's all caught back up on them. And now they need reserves, right? Because the banks are still going to require you to pay those reserves to get them out of foreclosure or keep them from going into foreclosure. So any back payments, any reserves that are needed to be paid, you'll have to satisfy, your buyer that you represent would have to satisfy that. And then you would put in place an agreement where you can start taking over those payments for the property. And then what you do on the end, if you're an investor, you can rent it out, lease it out. But if you're a retail client, you just actually want to live in that property, it's a great way to acquire a property without any of your own cash, credit. I mean, maybe a little bit of your cash, depending on the situation, but without any of your credit, you can just get into that property. And if you're a realtor or broker, you can help sellers that are in situations, pre-foreclosure situations, and talk to them and educate them about this process, so that then you can then go find a buyer that has the money, that can pay all of that, stop the foreclosure for them, transfer the deed, and then it is completely legal again. You go through a lawyer's office, make sure all your documentation is right. And if you're a buyer, if you're a broker, wholesaler, or a realtor, you would get paid on that down payment. You would just add a fee on the down payment part of it in order to get into that type of deal. So there's a great way to do it. The great way as well is it doesn't go, the buyer, it doesn't go on their, they're not a personal guarantee of the loan. So the loan never changes the name. And that's one thing you do have to educate your seller on, is that it stays in their name, but after so many payments, it can come off of their, like if they went to go out and buy another house, or they went to go out and get something that required to look at their DTI, like their debt to income ratio. After so many payments, they can actually, you can actually submit paperwork for your buyer to have over into the, to their, whoever they are trying to get financing with, to show that they are not responsible for this loan, even though it's in their name, they're not responsible for it. This person or entity now pays this is the agreement, and this shouldn't be reflected on their DTI. So you can always have that paperwork done for the seller, so that even though it is in their name, it's not on their DTI. And if for some reason the buyer stops paying for it, there are a lot of companies out there to do servicing for those situations, where the seller would never have to actually actively go into a foreclosure with that buyer. They can just hire out a firm that would do it for them. Now, that's getting more into the weeds, but first things first is, finding the right people that this kind of creative finance makes the most sense for, and it helps the most people, right? Subject to the existing financing. All right, so lastly, we'll talk about assumable mortgages. Assumable mortgages. Now, the assumable mortgage, it's just like a refinance. It is kind of creative finance, but I would say on this, and I'm not gonna. Well, actually, I got one more. I'm gonna tell you one more. That's the golden one, but it's kind of like a refinance. I've never used I've never assumed a mortgage before, because I've always said that because when you assume a mortgage, this is the only time when I would ever assume a mortgage is if the interest rate was spectacular, like it was a 1.87 or 2, something like that. Like it was the interest rate that they already have locked in on that was amazing. That's the only time you should consider assuming anyone's mortgage. If it's not, then you should just go out and get that. You just try to figure out your own financing, right? So with that being said, is assuming a mortgage, meaning you assuming all the terms from the previous owner, what they had on that mortgage for that particular property. The buyer just comes in and assumes all of that as well. That could work in this market because most likely the interest rates were a little bit lower than what they were before. But I will only suggest this if you're a broker, realtor, or wholesaler that has a seller that they will be willing to assume the mortgage, meaning that their name comes off the mortgage and the buyer names goes in it, right? They just slide into the buyer just slides into their place and takes over the mortgage. You have to have a good credit score because or considerable to what that credit score was. Because right now, especially, there's not a lot of advantages to banks to lock in these rates, these low rates, or keep them locked in for buyers when they know they can sell you another product at a higher interest rate. So you have to have an excellent credit score. You have to basically all your paperwork, it'll be just as if you were going in and you were want to apply for your own. The only difference is for some reason, the DTI that your buyer was at the cusp of the DTI, the debt to income ratio, and so they couldn't get approved for the house they want using today's interest rates because of the payments would be so high based on what their income is. And so when I say this, I want you to understand that you definitely need to have a strong, credible buyer that can do this, that can assume a mortgage from someone else, because the only benefit would be to them is that they have a lower interest rate and they're able to get in it because that DTI shifts, right? So they don't have to have as much income based on where their debt is, right? So I hope this makes sense. I was just reading a comment. Yes, I am to Shahab. I'm gonna just actually write my email here. You can just email me what you have. All right, so I told you this is a bonus, okay? Because I got a few more minutes. I got like 16 more minutes. So I got a bonus for you guys. So we went over owner finance, seller financing options for realtors, brokers, and wholesalers that have sellers or that will be willing to sell their property through terms versus through conventional, especially pro tip sellers, brokers, realtors, and wholesalers. I keep mentioning these groups because they sell the most amount of real estate that I've noticed. Is you want to make sure, right? When you're doing this, you want to make sure one that the property is actually free and clear, because you will spend a lot of time working on a property that is actually held up in probate than you want to. And then shoot, I forgot it. It'll come back to me. I should have wrote it down when I was thinking about it. What was I going to say? I was going to tell you about the owner finance, seller finance. Oh man, it was a good one too. I forgot it. But anyhow, so owner finance, seller finance, if they own it free and clear, okay, this would be a really good situation. Oh, I know what I was gonna say. How to market, how to find people to do this, to ask these questions with. Like we always get taught, I don't know if we get taught enough in our brokerages about how to go out and prospect, but not just expired listings, but definitely want to look at expired listings for people that did not sell their properties and call on them. Obviously, that's I don't think people do that enough, the expired listings. But also look at the days on market in your area. Whatever the average days on market are in your area, go and find properties that have been on market 60 days over what the average days on market are in that area. I was going to say 30, but keep it to 60, because what that tells you is they really want to sell their property. They haven't canceled the listing yet. They really want to sell their property, and they just don't have any buyers that can either afford their property or can buy their property with, at those terms. So present different terms to them, right? Like, so that's what I was trying to think of, is you want to make sure, pro tip is go back and prospect your MLS deals. Go back and look at expired listings. Go back and look at what your days on market is. And then you go 60 to 90 days out of whoever still has their property on the market, and you go and you prospect those people, right? Even if and I'm really big on not going around listing agents. Like unless they are not on the deal anymore, if it's still listed, don't go around listing agents, because that listing agent can bring you, if you build a really great relationship, will bring you more business. Don't go around listing agents. Don't go directly to the seller. Spend the time to educate the listing agent. I promise you, if this listing agent has had this listing on the market for 60, 90 days, over days on market, they're open ears to whatever you have as a possible solution for them. They may even say, I'm not going to be able to tell you to explain it to my seller like you did. Can you do it for me? Yeah, absolutely. Because they're going to get paid either way. So I don't want to go on a tangent about going outside of listing agents, but I feel very strongly about that. And then, so what you want to do, skipping back over, okay, wait a minute. We went over seller finance, owner finance. I gave you that pro tip. And then we went over subject to the existing mortgage, meaning the owner's name, the person that has the mortgage, it still stays in their name, but you take over payments and you have a limited power of attorney. You or your client has a limited power of attorney over their property, and they basically promise the seller that they're going to pay that lien if the deed is transferred over to their name. All right. So that's subject to the existing financing. Assuming the mortgage is basically you swapping. So the buyer comes in and they assume the mortgage based with the same terms, the same interest rates, and take over the payments, but the name changes, and now that debt is on their personal credit report or consumer profile, and the seller is out of the mix. A lot of sellers are going to want that, but the thing about it is, if you don't have a strong client wait list with strong credit scores and money is already sourced, W-2 set up, that they can definitely get approved for a mortgage, but their DTI was high, that's the only people that you should go to. If the DTI was high and they couldn't get approved, but everything else was strong, then instead of telling them, go pay off this, go pay off this, go pay off that, while you're doing that, go tap into your investment network or the companies that work with these type of sellers and see how they can assume the current mortgage on it. All right. So that's one other way. And then, because again, these asking prices are only because most of the time they have to pay off a mortgage, right? I mean, if the buyer was able to pay them what equity they're going to be walking away with, right? So maybe they're walking away with $25,000 in equity. And after they pay off everyone, if they were able to use that as the down payment, the buyers would say, well, that's just like my down payment. I'll just pay you that. That's your equity. You walk away, I'll take over the rest because you was just going to use that money to pay off the mortgage anyway. That's just how it all works. It's still selling at the same price, but the math just goes out different. Okay. Next one that I need more of my realtors, investors, wholesalers, and brokers to really get a list of is private money lenders. Private money lenders, especially if you're working with serial flippers, serial rehabbers, builders, developers, serial investors. These are what the products, this is why those products exist, because your traditional financing is just won't work. I mean, it will, but it's going to be tough, right? It's not as smooth. Private money lenders, if you don't know who those are, I'm actually creating a list of the really good ones that I like to use, that so the whole U.S. will be covered. But you want to get on, you want to contact and get your own private, as a realtor and a broker, I believe that you should have your own list of private money lenders. Private money lenders only lend to LLCs, so they have to have an entity. So if you are working with investors, builders, or rehabbers, that typically is a non-issue because they already have an LLC set up. If they don't, help them get one set up. I have a resource I actually can put. I just need to get a resource bank, but I do have a resource that will help them get from A to Z, get the whole thing set up. And you can have that whole thing set up by the time closing happens. As long as the LLC is there by the time closing happens, you're good. So get the LLC set up. They only lend to LLCs. Now, they do qualify you for the funding based on two things. They do qualify you based on your credit score. That's it. Not how much money you make, not any of those, because most of these programs, most of these lenders have either a no doc, low doc, or a stated income program. So your biggest thing is you have to have a credit score, and I would just say 680 and above. Some lenders I see are going down to 600. But just know that when you do that, your interest rate is going to be through the roof, right? You're going to be looking at 12-15% interest rate, and you're going to have to pay usually about 25 to 35% down to get the financing if they have a lower interest rate. So just, you don't have to remember all this. Contact a couple of private money lenders and see what their requirements are. And so you just start to build out your list of requirements. So you know when you're referring someone to them, one of your clients to them, you know what that particular lender is going to be looking for. So personal PG, that's the only thing that they're going to go off of. The next one is going to be just the asset itself, meaning the house itself. They're going to want to order their own appraisal. So they're going to have the appraiser to go out and appraise the house, and they're going to look at what the as-is value is, if it's a fix and flip, and then if it is and then what the after repair value would be. If it's a rental property, they're going to be looking at what the market value is for it, the as-is value. So they're going to want to do that, and they're going to look at what it looks like, right, based on your credit score and the asset. They're gonna lend a certain percentage based on the value. So let's just say it's a rental property. They're gonna lend you up to maybe 80%, sometimes 90%, not a lot, but 80%, maybe even 75% towards the as-is value, meaning you have to come to the table with the rest. Okay. For fix and flips, they're usually a little bit more lenient because there's a lot more spread there. So if you're going to do fix and flip, there are some people that do 90 to 100% of acquisition, meaning purchase price. So if you're representing a buyer, a builder, or a seller that you know that their sole purpose was to buy this property and then fix it up, then I would start introducing them to your sources of private money lenders, because they will lend up to 90 to 100%. on the money of the purchase to your client. And then they would also lend out 100% in rehab costs. And it goes over draws, but if they know this is how much it's going to cost to acquire it and this is how much it's going to cost to repair it, then especially if you have a really strong buyer that has experience, meaning they've done 3 or more deals in the last 2 years, and they have a high credit score, then they could possibly get into a deal with zero money out of pocket. You just got to know who to talk to. So you need to be able to have these conversations with your investor buyers and your builders so that you can help them get into the deals that you want to get into. The great thing about that, especially as a wholesaler and a realtor, is you can represent them that deal twice. You can represent them on the pre-rehab phase, on the acquisition, and then you can list it for them. So you can be a buyer's agent on the pre-rehab, and then you can be the listing agent on the after repair. Now, if you're a real good one and you are able to source your own deals with the sellers, then you could be the listing and the buyer's agent on both sides if you really have a strong list of everything. But it takes a lot to build that out, and it takes a team to build that type of out, because you got to be able to focus in on a certain niche before you can grow to be everything to all, right? So that is my creative finance little class. Now, will an hour get you to where you need to be? No, absolutely not. But I want you to know that these options are out there, and if you're really looking into get into real estate, this is how you should do it. Now, let me give you another pro tip about what if you're looking to buy your own house, right? What if you're looking to buy your own house and you can't figure out, but you're willing to put some effort into it and fix it up, like buying a fixer up? Or how do I get the money to do that if I don't really have the money, but I'm willing to put in the work? Okay, let me give you another pro tip. So another pro tip is you have an LLC and you acquire the property, right? You acquire the property in your LLC, you do the work, meaning you outsource the work, you get it fixed up. And then when you sell it or you rent it out and you refinance it, because you can refinance through the private money lenders as well. You refinance it in your LLC, and then you go and you rent it back out to yourself, or you write yourself a lease option for the individual. And then as your credit gets great and gets better and you are able to show those payments, on-time payments every time, then you go back when the market has dropped a little bit, and then you go and you apply for a conventional financing where the rates are cheaper, but your company was able to do it and fix it up, and then you're able to rent it back out to yourself, and then now you can get conventional funding. That gets high level. I just really threw that in there for you guys, but that's why it's important to understand how financing works and how the lending institution works and how creative financing works, because when you get to that point, then you should be able to release all the objections that you have about why you don't get into real estate. Just another tidbit, there are people that are willing to outside of private money lenders, there are people that are willing to lend you money, cold hard cash, to invest in properties. The deal just has to be a good deal. There are also people that if they don't have the cash, they have really great credit. They're willing to be credit partners also with you in really great deals. I would say only link up with people that have 620, 680 credit scores. I mean, not 680, but 720, 780 credit scores. And you need a credit partner. Like, you have the cash, but you don't have the credit. Get you a credit partner, and y'all do that together. And you just create an agreement about how you'll pay out. So there's a lot of ways. So that's why I say, if you're buying it, if you're only looking at banks to finance your deals right now, you're probably buying it wrong. You really want to look at the other ways of how you can get into creative finance in order to finance your real estate investments. And that is going to be all for me. Let me see. I can probably answer a couple questions. Let's see. I'm glad people jumped in. I think it gave a lot of value. I'm going to keep this on. I'm going to keep this on my page for the rest of the day, then I'll take it down. But look for the replay on my YouTube channel on Kelly Mead on YouTube. And then also I'll have some other videos coming this week about this particular topic. I'm only going to stay on creative finance for this week, so that you guys can go have all the tools you need and all the knowledge you need in order to go out and get it done. I'll talk to you later, guys. Have a great day. Bye.